Hey guys, welcome back to the channel. Today we'll be taking a look at straddles and their break-evens to test if they can give us some sort of market direction. So the chart you're looking at is for the SPY ETF. So this is year to date up until July 7th. So this last bar represents July 7th. And these black lines represent the break-even points for the at-the-money puts and at-the-money calls for all the expirations until year end. The person that buys these straddles will make money if the stock goes above or below these lines. But I wanted to check how likely it was for the stock to actually trade within this range. And in a later example, I'll show you the break-evens for a previous date, and we can check whether or not the ETF stayed within the range. For this tutorial, you will need some historical options change data, and I do have some videos on where you can scrape these so you can start collecting the data, whether it be from the CBOE, Yahoo Finance, or TD Ameritrade. So let's go take a look at the code so you can create this chart. Alright, here are some packages we're going to require. Now to get options change data, I will pull mine from my database. So I created this function where we just pass on the ticker we want to pull data for and the trade date, and it will go ahead and pull all the options chains that traded on that day. Within this function, we also calculate the break-evens. So if we open up this function, the first couple of lines just establish a connection with my database and pull the data and save it into table. Now if you don't have a database, but you do have options change data, your code will begin here where you have already subset the ticker you wanted and on what trade date. The data I have contains the stock close for that day. So here I'm just assigning the stock close. Now in order to calculate the break-evens, I need to extract all the expiration dates available. So here I'm just finding the unique cases for the expiration dates on these options. Now for each of these expiration dates, I'm going to pass these as a list and into this function where I subset the main table with all of our options to that specific expiration date. I will then split by calls and puts, and by using our stock close we have assigned up here, I will calculate the difference between the strike and the strike close. I will then assign the call and the put with the least difference. This will get me the at-the-money call and the at-the-money put. Now to get the break even, I sum the bid and the ask and divide by 2, add it to the strike price for the calls, and I subtract the difference from the put strike to get me the break even for that put. After we calculate that, I'm just going to R-bind the break even for the call and the put and return that as a data frame. So it'll loop through all the expirations, make the calculations, and return that as a data frame. So if we minimize this, after we return all the break evens for all the expirations on that trading day, I'm going to row bind our results. And all we really need for this tutorial is just a flag that symbols whether it's a call or a put, the strike price, the expiration date, the number of days to expiration, and the break even. So I'm just going to be returning these 5 columns for my options. Now if we minimize this function and run it, the ticker I wanted to check is the Spiders ETF. Here we're going to go ahead and assign it to a previous date so that we can see whether or not the ETF stayed within the range. So we're going to use May 31st of this year. Now I'm going to use my function to get the break-evens. Let's take a look at that table. And in this table we have a total of 68 entries ranging from May 31st all the way to December of 2024. We have our flags indicating whether this option is a call or a put, the strike price closest to the stock price, the days to expiration, and the break-evens. Now we need to get historical stock data. So I'm going to pull that from Yahoo Finance starting the 1st of this year. Now what we need to do is convert this options table into an XCS object so that we can merge it with our stock data. So within this block, I'm just going to split my options into calls and puts. I will then convert that into an XCS object and order by the expiration dates, and then reassign their column names to up if they're calls and down if they're puts. So let's run this block. I will then combine the calls with the puts. Now since we have options expiring in 2024, we need to create an empty XTS object, which we will then use to merge our options and our stock data, since our historical stock data ends July 7th. So we need those extra days so that we can combine our options with our stock data. So here I'm just creating a sequence of dates ranging from the very first date in our options data all the way to the last date in our options data, and I'm doing that by 1 day. Now we only want business days or trading days, so we're going to use our quantlibs is business day by passing in the NYC calendar and our dates. So we only extract business days. Now to create a blank XCS object, I'm just going to rep an A by the length of the dates, and I'm going to order by our dates. So if we take a look at our blank XTS object, we have one column with NAs and all of our dates ranging from May 31st all the way down to December 20th, 2024. All right. So then we're going to merge our blank XTS object with our options. And if we take a look at options, we see our break-evens. Since these are also trading days, I'm just going to use NALOCF to fill these NAs with the last observation and drop this empty column. So here I'm going to fill NAs and remove the first column or just subset by the up and down columns. So if we take a look at our options again, now we have a complete XTS object that we can merge with our stock data. All right, so for plotting purposes, I need to specify or extract the location where the index of our options matches the index of our historical stock data. And we're going to use that to create the text that will be plotted next to the break-even lines so that we know the exact break-even price for the call and the put. So let's run these lines. Now I'm going to create a chart theme and specify that the down bars are red and the up bars are green. Now I'm going to use chart series to plot my historical stock data and our option break-evens. And for technical analysis, I'm just going to add my options data on the same chart, assign ticker for the chart name, and also apply my theme. So if we maximize this chart, we can now see the year-to-date price for this ETF and the break-evens on May 31st all the way to December 20th, 2024. Now what is left to do is to add the break-even prices on the black line. So we do that by using these two lines where I specify the location on the x-axis, where to plot it. I'm just going to use the break-evens plus or minus 5. The label will be the break-even price and SRT is the angle. So I'm going to be rotating the text by 90 degrees. So if we run these two lines, now we take a look at our plot. Now we see the labels on the black lines, but let's go ahead and subset this for this year only. So exactly the same thing, except I'm just subsetting for 2022. We'll maximize the plot. All right, so for the break-evens on May 31st, we see that the ETF did not stay within the range up until this point, but it did trade range-bound for a couple of expirations, maybe 5 or 6, until it started breaking down. And I did check a couple of other trading dates, and at least for this year, we do have a couple of expirations where the stock price trades range-bound and then it breaks down. But at least for trading ideas, maybe we can sell verticals on the call side to be even safer, just so that we can collect some premium. Well guys, this concludes the video. I'll go ahead and leave a link down in the description area to the Patreon where you can find the script, and I'll also be providing some sample data. Please subscribe to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.